All right, all right. Good evening, traders. I don't know what happened. It kept like starting the wrong meeting. I'm like, where is everybody? Then I'm like, oh, that's the wrong meeting. So if you were sitting there for a second, that's why. Strange. Hi, Perry. Good to see you. We're going to give it just a second. I know we're a minute late, so we're going to dive in. You should see my screen. This is a big one. A lot of times when to provide some context, a lot of times, even when I get buy-in on record keeping, a lot of times they sort of just slow down there and they don't get that last piece, that last connection, which is the granular level, right? The devil is in the details. And that's what we're looking for in our post-trade assessments. The record keeping is more of an aggregate perspective. How many have I had? What's my winning percentage of all of them? And what's my losing percentage of all of them? And what's my average win across all of them? And that's an aggregate perspective, which is super helpful for us to understand is the big picture working. But this is the granular level. This is the details where we can really dive in. And this is where we're looking to fine tune. And so I don't do it anymore. I'm not going to say that I do, but what I used to do, what I would each week focus on one specific thing. So I would cycle through and I would randomly pick. One week I would focus on winners and I'd randomly pick 3 winners to do a post trade. Early on, I used to do every single trade, which is I'd recommend that. Now I just sort of do samples and I'll pick 3 winners, 3 losers the next time, 3 random trades, just random selection, grab it, analyze it. How did you do? In the beginning, especially if you're only trading, 5 to 10 times a week. I mean, if you're trading more than that, it's a little harder, but I would definitely say post-trade analysis on every single trade. Every trade has something for you to start spotting patterns. The more you do it, the more likely you are to find a pattern. And we're really looking to fine tune and think about our rules, all of our various. So we're breaking the trade down into its various components and then thinking about the rules that inform the decisions in each of those different components, starting with setup, trigger, initial stop, and risk management considerations, the way that we manage the trade, tighten stops, take profits, tighten, adhere to targets, etc. And so we really want to break it down into each component to say, all right, how did we do in stage 1, stage 2, stage 3, stage 4, and look to flag things that we think this wasn't good enough or this could be better. And as we flag those, and then we see multiple flags, then we think there's a pattern. That's fixable now. And it's a very deliberate approach. So good morning, Sandy. Good to see you. Hi, Bob. We're a little light today. What a big turnaround the market had. Hopefully you kept some things. I shut down some, but actually I still kept a little hedge just in case because I don't have full confirmation yet. But certainly that's turned around. It started some new bullish trades. Hopefully you guys got some things in the works. Anyways, let's dive into it. Welcome to the Market Watch Group Trading Foundation's post-trade assessments. Here's the disclaimers. As always, education, illustrative only. We are not advisors. This does not constitute advice or recommendations. Here's our agenda today. Trade overview. We're going to talk about our pre-trade assessment. We're going to talk about incorporating market conditions. That is a fatal flaw for a lot of people when they go backwards and they look to do a historical review. You can't just look at a trade as some independent event that exists in a vacuum. It doesn't exist in a vacuum at all. In fact, it's quite the contrary. if you're going to evaluate a trade, you should start with what was the market at that time, because now you can go back and you can say, in hindsight, clearly it was what? Then we go to our log and we say, what did you think it was? Because if it was A and you're like, oh, I thought it was C, well, you just found an issue. that's going to be a big contributing factor to your lackluster trading, potentially, right? And so if the market was A and you're like, yeah, I saw it as A, okay, you had the market right. So then what happened? And then you go on to the next thing, and it's a root cause analysis. We're trying to dive, and we can't stop with one question. We've got to ask another question, and then another question, and then another question. And let's figure out that we're not putting band-aids on in our trading, but we're actually addressing issues. Rule adherence. Well, how is your discipline? I would suggest a scale, 1 to 10. How'd you do? Think about it like a grade. 9 is a A, 8 is a B, 7 is a C, 6 is a D, 5 or below is failing. So assess yourself and make sure that you see that if there's an area where you're 6 or 7, figure it out. Set a goal around that area and start making progress. We'll talk about risk management. We'll talk about trade management. We'll talk about overall trade assessment, lessons learned, and then how do we take all of that information? We're still going to take the granular, develop our hypotheses and our ideas for how we can improve, and then we're going to turn them into aggregations for adjustments. What do we do with these patterns? Okay. Oh, I'll tell you what, this is one of my favorites. This is one of the things, again, what do I say? Successful traders do what failing traders don't want to. This is where you're really learning, and you're learning from yourself. You're learning from, how am I doing relative to my perspective on the market? I can't rely on someone else's perspective and then trade. It's got to be my perspective, and then it's got to be my trades, and then I'm going to learn from that. So trade details, obviously we're logging it, date of the trade, symbol, trade instrument, entry, exit, position size. I mean, everything this is just a quick overview of what we want to do. It's all that's in the log. It's done for you. All you have to do is fill out the log. That's it. Adopt that methodology. It's simple yet effective. Are there better logs than that? Of course there are. You can pay for some really crazy logs. What I have is what requires the minimum effort. I know this may sound terrible, but look, I'm a pragmatic guy. What will satisfy the minimum amount of information that I need to input into the spreadsheet and yet still produce the analytical variables that will actually give me the data I need for the the high level overview. That's it. That's what we have. Now, the rest of this, I'm thinking about it. Maybe I will create some kind of a formal structure. I don't know if it would be like a Word document for a little bit more detail, or if it would be like a trade assessment spreadsheet where you could make notes and score yourself, and then you could keep like an average. What's my average? What's my rolling average, so that you could look to see that you're improving your own. I'm thinking about that. Think on that, and if you have any ideas of like what would be the right format, the more we can, standardize routines, the better. So what are we looking to assess? Well, first and foremost, what indicators are you using, and how much confirmation did they give? What did they show you as you made your decision? Did you wait for full confirmation? Yeah, like a checklist, almost kind of like a checklist, but you're doing a post-trade assessment, right? Where you're going back and you're saying, this is what I'm supposed to do. How did I do it? Right now you might say to yourself, oh, you know what? I had too many trades where you're marking whether or not it was an anticipatory trade. Did you anticipate or not? And if all of a sudden you're like, man, you know what? Before I knew it, and this is me personally, I've had this happen, this exact realization, where I'm like, oh, I'm anticipating every damn trade now. It can't be considered anticipatory if it's now the rule of thumb, right? And so, that's something that I was thinking about for sure, was how do I see that? Oh, there you go. I see it because I'm forcing myself. Scaled 1 to 10 with notes. That's what I'm thinking. Something along those lines. Chart patterns and trends. Did you see a pattern? Was the pattern confirmed? We had an interesting discussion earlier this week about a potential double top and a potential ascending triangle. Let me remind you of said discussion, which was an interesting one. AIG popped early. Anyone looking for that one? Market, you can see now, look at this. We said this is not an ascending. Couple of things you'll notice. Notice number one, even on this negative day, by the time it got to the end of the day, where was it? I feel great about my trend lines. Right back up in that trend line where it never broke. And then what happened? Bam. We broke to the upside. We got volume. Did we get 105%? Average is 74 million. Oh, I don't think we did. Ooh, this will be interesting, you guys. This will be interesting. We had 70. Let's see. What was the average? I don't think it did. It looks like it was going to 74,387 is the average times 1.05. We needed 78. We got 76. Oh, interesting. Okay. However, we did get a higher high. It did break the top of the triangle. It never broke the bottom of the double top. So that's why you don't make the judgment in advance, right? Some people see something hit resistance twice. They're like, double top, it's reversing. No. What? No. Relax. Be patient. Okay. So what patterns or trends did you use? So this is really, you're evaluating your technical analysis. Did you see a setup? Did you take it at the right time? Did you jump it too early? Did you wait too long? What was it you were using? Did you wait for the Heikin Ashi? Did you jump it? What was your reward to risk ratio? So you want to make sure that you're noting what was your exact entry point, because when you buy an option, one thing you can do is you can actually go back and you can see at what time did my option trade fill. Then you can go look at the stock and find out what price was it at that time. You could look at a 1 minute chart, be like, oh yeah, at that minute, here's what it was. Mark it down. Think about where your stop was, where your target was. What was your reward to risk ratio? Are you achieving 2.5 to 1 on entry or better, or a minimum 2 to 1? And what was your thought process for the chosen ratio, right? There's times where I'm like, you know what? I jumped it early, but it gave me a 4 to 1 versus, you know what? I only had a 2.5 to 1 reward to risk ratio, but I already had Heikin Ashi confirmation. Talk about it to yourself. Write it down. What did you have? What made sense? Because then you can see, was that logic sound? Or if I've used that logic 5 times and 4 out of 5 times it's failed, then we need to recognize that logic isn't holding up. It's not holding water. Market conditions. This is the big one. A lot of people talk about, yeah, go back and learn from your trade. And then they skip this step. I mean, honestly, I would say 99% of educators, coaches, mentors that I've ever seen, they don't mention this. And the problem is, even if you mentioned it, if you don't have objective records of what your thought process of a market was, I don't believe you can trust what you think you thought it was 3 months ago. I don't think you could look back and be like, well, you know what? I think you need to have an objective record that indicates this is how I scored it, because the decisions you made at that time are rooted in the score that you had. So that's part of why it's not just that we keep this because it's great to be organized that way. It creates a historical record that allows us to add this market conditions dimension to how we look backwards, evaluate, assess, and improve going forward. So what do we want to know? We want to look at what was the market doing, major market characteristics, performance, a little before, a little after, so you can see the whole picture. You're not at the hard right edge. You're looking backwards. Hindsight bias. Love it. Because we have the ability to objectively quantify, is what it was doing what we thought it was doing? Or did we miss? And if we missed, what? What did we miss? Because if I miss something 2, 3, 4 times in a row, and every time I say, what did I miss? If it's pointing to the same thing, there you go. You just found a problem. Fix it. Great. Find a problem, fix a problem. That's our Kaizen philosophy and what we're doing here. So you want to understand not just what was your posture, but what was the impact of the overall evaluation of the market on that trade? How did it impact that trade? Next, the next thing you're going to look at and assess is how well did you adhere to your rules? That's it. Did you break a rule? A lot of people are like, oh, I only broke one rule throughout. We really want no breaking of rules. If you break your rule, that's like you should immediately give yourself an 8. It's a B at best. You break one rule, that trade, no matter what, is a B at best. If you break 2 rules, it's an F. It's 80, 50, nothing, right? It's that you got to be pretty strict here and hold yourself to account. And this is a mechanism where we know we're going to assess ourselves. It may not seem like much, but to me, it can be very, very helpful in helping to maintain our discipline. Did you follow it? Now, what we want to do is we want to make sure that if we deviated, that we do 2 things. Number 1, flag it so that we can keep track of if that's a one-off or is it a pattern. Number 2, assess the impact. I've actually gone back where I looked at a year and I took 2 trades. I took the worst time that I didn't exit when I was supposed to and my loss got bigger, and the worst time that I exited too soon and my gain wasn't as big as it should have been. 2 things. And I say, how much did that hurt? Those 2 trades. You'll never like the answer. You'll be like, what? But it's nice to give yourself that, we love to have the carrot, but sometimes we need the stick. And we need to kind of be like, that hurt. Don't do that anymore. And so we want to make sure we really understand the impact that breaking our rules has. It's the monkey's fault for sure, but you're the one in charge of the monkey. It's your cage. So make sure you keep track. Risk management. The good, the bad, and the ugly. Bob, you're right. So the next component that we're going to assess, and this is a critical one that it's part of our rules for sure, but we have to do a risk management assessment. So we need to assess where we placed our stop and how effective was it. So did we place it way too far away because we were nervous? Because remember, way too far away is going to reduce your reward to risk ratio. Do we place it way too close and get picked off? Right. That might be what happened is you got stopped out and then you look at it and you're like, that was too tight. Too tight. If I have a too tight stop loss every now and again, I can live with that. That's my son is a soccer player and I coached him when he was younger. I said, you're not trying to not be offsides, right? If you're never offsides, that means you're never taking a chance to just like time it and get behind it. You got to take a chance for sure. I'm okay. If you're offsides every single time, that's a problem. Same thing here, right? You're going to have a stop loss pick you off here and there. That's okay. What you're looking for is the frequency of that. Now, if you have it, if you're keeping records and you're marking, I love marking the cells. When I take a loss that's almost too big, I mark the cell yellow. If I take a loss that's too big, I mark my cell red. We don't have a individual reward to risk column. No, it was cumbersome. I've had it before, but it was like it was getting so much that, you know, that's something that you can add the columns if you want it. You can put it in the notes where you just simply say, you know, stop at X, target at Y, R to R equals, and put it in there. You know, you could add a column where you could just type that in so it doesn't disrupt. But yeah, that's a great idea. So there you go. So we're assessing the reward to risk ratio. We're assessing any adjustments that we made. Did we tighten the stop to adjust risk? Did we do it too soon? Did we not go soon enough? How tight did we go? Did the Heiken Ashi work? Did we switch to a 4-hour? When did we do it? Did that make right? We're just sort of looking at it and saying, hey, let's learn from it. Let's be open-minded to, is there a pattern? So next thing we're going to look at is our trade management strategies. This would be dynamic stop loss adjustments. Are you using an automatic trail stop? Are you using the Heiken Ashis? Are you using the daily or the 4-hour? Are you taking profits? If so, where and how much? Right? If you notice, there are some markets where I'm like, I'm taking half after 3 days. And then there's some markets where I'm like, I'm taking only like a quarter and I'm going to give it 5 days. Okay. You would imagine my market posture score is much lower on the first one, right? Where it's like, this market's a little iffy. Great. Then trade it like it's an iffy market. It's not just the number of trades or the overall trade risk. It's how we affect our stop loss adjustments. It's how we take profits, what percentage and how quickly and where. It's what we do when we get near target prices. Do we set alerts so it says, hey, it's within 50 cents of your target? The last thing, and I'm sure we've all had that. I've had things get within like a penny or two, and then by the time it ends, it's back $1 away. And then what do we do? Well, let's see what happens tomorrow. And then the next day, it's down another $1, and you're like, oh my gosh, that close. That close. We don't want things to get that close and not have something say, hey, I can have it send me a text. Hey, you're about 50 cents away. You want to go take a look? Make sure it doesn't get away from you. These are the little tricks that just help us manage things better. Where if something got away from you, what could you do to prevent that next time? Lastly, adaptive exit strategy analysis. Look at, were you flexible? Look at, did you reassess? Did you look at those new candles? Did you see new information come? Sometimes we just, it's that oh my gosh, I'm losing my mind. Inattentional blindness. When we program our mind a certain way, we don't see things that are happening. We just sort of look through it, around it, past it. We got to make sure that we're open and flexible, that we're learning, responding to the changing dynamics. Could we have a session on calculating reward to risk? You know what? We've got 2 sessions next week. One of them is just Q&A. The other one is, I have no idea. I'm not sure. I've got to figure it out. We could do 2 Q&As. Definitely. You could say, hey, Scott, let's spend 10 minutes on reward to risk. And I could show you, some specific things, but yes, the answer is yes, of course. Anything for you, Sandy. Lessons learned. As we do this and we say, what are my scores? I want to look at the lessons should be learned, first of all, on an individual level. What did I learn from this trade? Then I want to look at the assessments from this trade relative to the patterns. Is my average score an 8 and I got a 9? Giddy up. Well done. Is my average score an 8 and I got a 7? Okay. Mark it down. Let's do a little deeper dive there to kind of figure out what happened that we are underperforming expectations in that situation. So when we do this, it is a bit of micromanaging to just really make sure that, remember, what we're trying to do is develop an inherent trust and confidence in our trading plan. We got to be intimately familiar with it in this manner. So that's what we're trying to do with it. What else do we want to know? What worked well? This is these lessons learned. This is something I took from a personal hero of mine, a man named Bruce Lee. I was a big fan of kung fu movies as a child, still am. My wife would tell you. But he wrote a book called The Tao of Jeet Kune Do, which is a sort of philosophy, sort of a martial arts book, really interesting book. But he said in martial arts or in any process, you boil it down, there's three steps to be taken to improve something. And that's what we're doing here. Number 1, find what's working and keep doing it. That's what we're saying. What worked well? Recognize and highlight the aspects of the trade that contributed to success. My entry was on point. I set a great stop. I'm moving my stops much better and being patient, letting this trade develop. Great. Find those things and emphasize them in order to replicate the positive outcomes that they provide. Step 2, find what's working and stop doing it. Man goes to the doctor. He says, "Doctor, it hurts when I do this." And the doctor says, "Stop doing that." Areas for improvement. Reflect on the aspects of the trade that we can remove because it's not working, or that we can improve, that we can refine or enhance. That's a big piece of this. It's like, is that as good as it can be? Maybe. I mean, maybe that part is, and you're looking at something else, and then all of a sudden, when you then a different market, that part's not. We're constantly looking to see, always open to it. What can we do better? Lastly, any observations of pre-patterns, right? We already said that we're looking for patterns where we're like, what is this relative to the established trends we have with how well we did setups, or how well, right, with all of these various components, these broken down components. But we're also looking for pre-patterns where we're like, oh, you know what? I think I might do this. And then all of a sudden we can go back to some other trade analyses we've done to see, did I do that and just not notice it? And we can flag it for future consideration to say, is that something that's inhibiting me, that's acting as some kind of an obstacle or impediment to our progress? Pre-patterns. Those are the lessons we're looking for when we do this. I tell people all the time, when you get to this point where you've standardized your trading plan, you've standardized, and you're committed to the record keeping, you're starting to see the data come in, and now you start implementing these post-trade assessments. You are so primed to just start learning, but not learning like book learning. That's theoretical learning, which is good. We have to have that to establish the foundation. This is practical learning, right? This is application learning. This is experience that is developed in a construct that allows us to constantly be seeing ways to improve. It's very exciting, I think. I mean, it's a lot of fun when you feel like you are in control, right? If you feel like you're at the whim of the market, like, oh, the market just, yeah, that sucks, man. Nobody wants that. If we feel like we're in control, it has a whole different connotation with what it is that we do and how we do it. Very methodical. So, okay, now what we do is we start aggregating. Love the challenge of it, Sandy says. Yes, yes. Still learning the platform properly. Yeah, it's you can't underestimate the importance of the platform and getting comfortable with the software that you're using, for sure. Okay, aggregating for adjustments, the aggregation of marginal improvement. My philosophy of life. We want to make sure we understand, like, yeah, you know what? A lot of people, when they first are learning to trade, and if they were doing something else and they join the group, they could certainly make some dramatic changes to their trading in a few ways. Once you get into like what we do, it's, it's about the routine. If it feels like a roller coaster, you're doing something wrong. It should be much more methodical than that. So we want to understand that that's how things are going to come. Small continuous improvements that aggregated over time lead to consistent and overall progress. So that's it. We're looking for a cumulative effect that transforms our process, approach, and outcomes. Do not throw spaghetti at the wall, right? We don't just like, oh, I'm going to just try this, right? It just sounds so random, some of the things people do. They just throw a new indicator in there. You are building a very delicate ecosystem with your trading rules and system and your record keeping and the way everything ties in. You can't just introduce something willy-nilly thing to that. Everything we do should be purposeful and deliberate. We should have a very specific reason why. It's the scientific method. We have a hypothesis. If I X, then I expect Y, right? And we should have some idea of that so that when we put it into play, we know what we're looking for in our record keeping that's going to demonstrate that it's either working and we can keep doing it, or it's not working and we can get rid of it. Okay. Lastly, we cannot improve what we cannot measure, and we cannot measure anything that is random. That is the process that we go through. We first standardize every rule, every routine, everything that we do is standardized. Now we have the ability to isolate each component to say, how does this contribute? If I need to improve something, what would the outcome of this part of the system or this rule or this routine be? Because then as we measure our results, we can say, hey, yeah, look at this. I've got a positive expectancy. I think I can improve that positive expectancy. But now that I'm measuring it, I can start to have my if-then statements that allow me to test my theories and my hypotheses. We have to embrace metrics and the concept of quantifiable data. If you can't measure it, there's no way that you're going to identify areas that you can improve. We must use clear metrics to inform and guide the improvement journey, which is the best part of this, right? This is when things really get good, is when you get to this point. And you stop asking these, like, you look into the sky, why? Yeah, we know why. Come on. It's so dramatic. We know why. We can quickly figure out why. Why is it not working? What do you need to do better? It's all here. Why? Questions and answers. Let's talk about this. It's not a long session. Oh, I think I'm going to, as I've been talking through this, I think I can come up with some kind of a formal, post-trade assessment. I'm thinking a spreadsheet, I don't want it to be too long, where you have like same kind of thing we do now. You put the trade in. What was the trade, the entry, the exit, profit or loss, just so you have a little context. And then you score it. And then maybe on a separate tab, we have some kind of a running scoreboard. That's what I'm envisioning. Thoughts? What do you guys think? Does that sound like something that would you use that? I mean, we want this to fit into our hour to hour and a half a day, 10 to 12 hours a week. Would that be something I think it would be extraordinarily helpful to help see and recognize, patterns and isolate things that can be improved. Sandy says yes. Bob says me too. Love it. Love it. Okay. Yeah, let's put that together. Maybe I'll try to come up with like an initial concept that I can share, and we'll see what we think about that. Any questions about post-trade assessments? And is it November already? Oh gosh, Thanksgiving. That's funny. I will not. It's not Thanksgiving. We did this one last time. I didn't even see that. We did this obviously right at Thanksgiving last year in our first round of the Trading Foundations course. Yeah, okay. Well, now a quick update. You might say, Scott, you keep telling us about the alerts. We decided we wanted to, based on some feedback, implement this in a format. We do want to use the Discord, but I think it's going to be something where we send the information via it'll go out via SMS, via text. So it'll be a text and a Discord. In case you don't have Discord handy, you might have an issue with anyways. We're in the process of getting the text aspect set up. So that just put a little bit of a delay. The expectation is it'll be next week. So anyone who's been waiting for that, apologies. We know that we're going to have to launch it and then continue to improve it, just like everything. But we do want to get it to a certain point before we go live. So anyways, that's the update. It's not, next week is not Thanksgiving, but next week, I don't know. We had a formal Q&A, like end of the Trading Foundations. What questions do you have from any aspect of any day? But I want to do something a little more formal. So one of those 2 days, I'm going to think of something. Maybe we'll do a record keeping. I have 2 people who have given me their 100 trade, their first 100 trade logs. And so I've offered to use them, and both have agreed to let theirs be used as an example. I'm thinking maybe we do that. I think that would be a cool exercise, because that would help you to kind of see, like, real time, what are we doing to somebody's numbers to try to learn from it and figure some things out. So, all right. Well, tomorrow, looking for a bullish market to continue. We'll see what our continuation is, our follow through. We're going to meet in the afternoon at 3:15 p.m. Eastern time. I hope you can join me for the weekly market wrap up. I appreciate you coming tonight. I hope I have your buy-in for post-trade assessments. I hope I've convinced you. Sometimes I feel like I'm a little repetitive, but I'm evangelizing for these routines to kind of say, hey, it's easier than you think to just sort of establish some sort of a cadence with it, and the benefit, oh, it's off the charts. Sandy says sorely needed. Good. Well, I hope it's helpful. It's good to see everybody. I hope you have a great rest of your night. See you tomorrow. And as always, happy trading.